In this example, we're going to record a series of adjusting entries for a company named Company A. So at period's end, in Company A's case, at the end of June, they need to make a series of adjustments to make sure of two things. One, that all expenses that were actually incurred during the period are recorded in the same period as the expense was incurred, and all of the revenues that they actually earned during the period go on the books in the same period the revenues were earned. So what we need to do right now is make 7 very common adjustments that most companies make at period's end. And for Company A, the first one we have is the adjustment for supplies used. To do this, you're going to need two things. You're going to need to know what is your current book balance of supplies. Well, you would go to your T accounts and find what the balance of your supplies T is. And in our problem right here, it tells us the current balance of Company A's supplies account is $12,000, which I'll make red so it stands out. That is how much we had in supplies. At some point in time during the month of June, Company A owned $12,000 worth of supplies, and they used them during the period, and they didn't record an expense every single time they used a supply because that would be madness. What they did is at period's end, they sent somebody out to physically count the inventory to determine what amount of inventory they had, as they say, on hand. And our physical count revealed that Company A still owned $8,100 worth of supplies at period's end. So we need to make an adjustment for what got used, and that's the difference between what we had, $12,000, and what we ended up with, $8,100. The formula is the book value of supplies minus supplies on hand. So for us, that would be equal to, I'll put it over here in the debit, $12,000 that we had minus the $8,100 that we have remaining at period's end. That's $3,900. We used $3,900 worth of supplies during the period, which means we get to record a supplies expense for that amount. And I know this is my debit because it is an expense account. It is increasing. We're tracking how much we used for supplies, what our expenses that's going to offset our income and save us on our taxes during the period. And the amount that we have in that pool just went up, $3,900. And the other thing that needs to change, in this case get credited, is we need to reduce our supplies from what our books are saying that we had, $12,000, down to what we actually have. Well, supplies are asset accounts. Asset accounts decrease on the credit side, so we're going to throw supplies a credit for $3,900. And this is the standard setup for the adjustment for supplies used, which Company A is recording on June 30th. So we're going to have the 6/30 adjustment, and it is the adjustment for supplies used. Another adjustment that any company that has an outstanding loan is going to have to make is the adjustment to accrue interest on the loan. As you owe money to another party, they're always charging you interest. The extra amount of money you owe them is that interest expense is going to just keep going up and up and up. So when the interest accrues, when the balance owed on your note increases, you're going to have to record that interest in the same period that it accumulated on the loan. So we know we're going to need a debit to interest expense here. But how much expense, how much interest is accumulating on this note during the month we are adjusting for, which is June? Well, to do that, we're going to use the standard interest formula. We need 3 things. We need how much was owed on the note. And it says right here, the current principal balance of the note is $16,200. We need to know the agreed upon annual percentage rate, and our stated APR is 6%. So we agreed to pay 6% interest every year on this loan. We also need to know time, how many periods we are adjusting for, and we are adjusting for 1 month. So using that formula, it's going to be principal times rate times time. Let's fill in our inputs. This would be equal to the $16,200 principal balance of the loan times the stated rate that we agreed to, which we found was 6%, times time. That's 6% for the year, but we're only adjusting for 1 month, so I need to multiply by 1/12. And I come up with $81. $81 worth of interest has accumulated on this note during the month of June, and we get to record the expense in the same period that it accumulated. This interest is now owed to our lender, to the bank that we borrowed from, which means we need to establish a liability for interest that is owed to this other party. And like all liability accounts, it's going to go up on the credit side. So we're going to need a credit to a liability. What is this liability for? It's for interest owed. So we're going to put it to interest payable. And that is the standard form for the interest accrual adjusting entry that companies will make every period as long as they have a loan outstanding. Company A is recording theirs on June 30th. So on a June 30th adjusting entry, we adjusted for accrued loan interest. A lot of companies will have contracts where they are going to perform services or provide goods later on over a period of time, but payment doesn't happen periodically during the life of that contract. For the purpose of this course so far, I've always got two setups. Either you're getting all of the money at the beginning or all of the money at the end. We need to recognize the portion of it that we actually earned. So let's look at the pertinence that we have right here. We want to know what is the contract amount. And in this case, under the terms of this contract, Company A is going to get paid $15,000 in cash. That is the contract amount. We need to know when this is occurring. When are they getting paid? They're getting paid at the end of the contract. At the end, which means that cash has not changed hands at all yet in this transaction. We're not getting it until the end of this contract. And when does this contract end? Well, at the beginning of June, we signed a contract to provide 6 months worth of services. So here we're going to be recognizing the revenues that we actually earned on this contract. Revenues are an account that increases on the credit side. We know we're going to have to credit our service revenue account because we actually earned some of this $15,000. Even if we, at the end of June, said we're terminating this contract, we're still going to expect our customer, B company, to pay us for the amount that we actually earned. So how do I find this? Well, I take the contract amount and I multiply it by the number of periods earned over the number of periods in the contract. We're basically figuring out what proportion of this amount we've actually earned. Well, we're going to take our contract amount, which we know to be $15,000, and I'm going to multiply that by the number of periods earned. We signed this at the beginning of June. It's now the end of June. That's 1 month over how long the contract is for, and it's a 6-month contract. So if we did 1 month's worth of work on our 6-month contract, we should be able to recognize 1/6 of the contract amount as earned revenues, and we're going to do that right here for $2,500. What is my debit going to be? Well, we don't have the cash right now. They're not paying us until the 6 months is over. We provided the full 6 months worth of service. But even if we terminated this contract early, I think they still owe us that money right now for the stuff that we actually did. And since they owe us money at some point in the future, we're going to receive it. So my debit is going to be to accounts receivable for that same $2,500. And it is my debit because it is an asset account. It is increasing. More money is owed to us by customers, and asset accounts increase on the debit side. So in this entry, we're going to have a June 30th adjustment for accrued revenues. We adjusted for accrued revenues earned. In the next adjusting entry, put the date in, also happening on June 30th, make an adjustment at the end of June, we have another contract that we got to be recognizing revenues on. At the beginning of June, we signed a contract to provide 24 months worth of services to Z Incorporated, and under the terms of this contract, we got paid the full contract amount of $36,000 in advance. Let's grab the same points that we did up above. The contract amount is $36,000. When did payment happen? This contract, it was at the end, but this time we got it in advance, which means we were paid before we provided any service. And how long are we now obligated to provide the service for? The terms of this contract stated it's for 24 months. So we are going to recognize service revenue equal to the proportion that we have actually earned, and we can use the same formula that we did up above. The contract amount is $36,000. We're going to multiply that by the number of periods we have actually earned. We signed this at the beginning of June, it's the end of June, which means 1 month, over the number of months in the contract, and the contract is for 24 months. So we did 1 months worth of work in a 24-month contract, we're going to recognize 1/24 of the contract amount as actual earned revenues, and that is $1,500. So what is my debit here? Would I put accounts receivable on the books? No, because that means they would owe us money. And if they paid us the full amount in advance, they definitely don't owe us any more money. What would have happened when we received that payment in advance? Well, we would have had to put the cash on the books at the time that they paid us, at the beginning of June, but we had not earned any of the revenues then yet. So we would have had to create a liability account, which I'm sure you all know by now is unearned revenue. And we would have this sitting on our books saying we owe, in this case, Z Incorporated, $36,000 worth of work. Well, we did some of that during the period, which means we owe them less work in the future. So my debit to unearned revenues for the same amount for $15,000. And here we adjusted for deferred revenues owned. So what's the difference between these two? It's the same exact procedure and same formula. You're always going to have a credit to service revenue. What differs is the debit. If payment is happening at the end, you wouldn't have unearned revenue on your books, so you'd have to record a receivable for the amount of money that is owed to you. If the payment happened in advance of the time, you would have that unearned revenue on the books, and you'd have to decrease your unearned revenue by the amount that you actually earned. So that is the difference between these two entries. Recognizing, am I going to have an unearned revenue account right now because payment happened in advance or not? And if the case is not, then you got to put a receivable on the books. Next up, this company has to make an adjustment for salaries that their employees earned during this month of June that they're not going to be paid for until a subsequent period. So you need to find some points in here. You need to find how much they're typically paid and what time period are they paid that for. Well, the first line tells us that. Company A's employees are typically paid $9,500 for every 5-day work week. And if the month ends in the midst of a work week, you would prorate out the portion of that they've actually earned. Well, the month of June ends on a Thursday, and Company A's employees worked 4 days that they have not been paid for yet because they're not getting paid until July. So we're assuming July 1st is payday. Well, even though July 1st is payday, we can't put that full salaries expense, which I'll throw into my debit spot, on the books right now. In July, because not all of it actually happened during July. We got to figure out what portion of it happened during June so it can go on June's books. And to figure out what portion it is, what we're going to do is we're going to take salaries during a normal period, and we're going to multiply that by the number of days worked over the number of days in a normal period. So for us, salaries are typically $9,500 a week. Our employees have worked 4 days since the last time that they were paid during the month of June, out of the 5 days that they're eventually going to be paid for. So another way to look at it is 4/5 of this pay period is occurring during the month of June. Let's put 4/5 of their weekly pay onto the books in June, and that comes out to $7,600. So our employees made $7,600 working during the period of June that they won't be paid for until July. But we need to have that expense on the books in the period that matches when it was actually incurred. But we're not paying these salaries. They're owed to our employees, which means since we owe something, we need a liability. What do we owe? We owe salaries. So my credit is going to be to salaries payable for that same $7,600. And here we adjusted for accrued salaries owed. The next adjustment is the one with the most complex formula. We are going to buy assets that we're not just going to use for one period or one period only, but we're going to have them be long held. We're going to use them over a very, very long period of time. And we need some kind of logical way to expense that asset for the portion of its cost that we used up. Assets don't last forever. They're eventually going to stop running. We need to find some kind of way to depreciate those assets and record the expense for the amount of value that they lost during the period. And when you do so, you need to make some estimates. You need to make an estimate about how long you're going to use it for and what you think you can get for it when you're done using that particular asset. Company A has two assets that need to be depreciated on their books, their building and their equipment. The building that we have originally cost us $200,000. I'm going to highlight that right there because that is the historical cost of the building. We estimate that we're going to use that building for 20 years, and when we are done using the building, we'd be able to resell it for $80,000, assuming that we didn't make any improvements to it during the period. We just bought it and then used the hell out of it for 20 years, and then decided to get rid of it when it's semi-dilapidated. We could still sell it for 80 grand. Equipment is the other asset that needs to be depreciated. Let's find the same 3 points for that. Our equipment had a historical cost, or original purchase price, if you will, of $40,000. We expect that we're going to be able to sell or scrap this thing for $4 grand at the end of its life. And we are expecting that we're going to be able to use this piece of equipment for 8 years. So we need to find some way to depreciate that. We're going to depreciate it using the straight line method, which means we're going to take an equal chunk of the value it's going to lose over its life away from those assets every single month. The formula for straight line depreciation of all assets is historical cost minus residual value. The difference between what you paid for it originally and what it's going to be worth at the end of its life, because that difference is how much value it has to lose. And then we're going to break it down into chunks by first multiplying by 1 over how long we think we're going to use the asset for, 1 over useful life. And then we're going to multiply that, since our useful life is in years, by the number of months we are depreciating for over 12. So the setup for this is going to record a depreciation expense. We'll start with a debits to that account, but I don't have the number yet. We're going to need not 1 but 2 credits because we have 2 different types of depreciable assets. And they're going to go to our accumulated depreciation accounts, which you can abbreviate to ACDEP. So the first one is accumulated depreciation on our building. So accumulated depreciation of buildings. As contra asset account going up. And this account is going to keep track of how much value that building has lost over its life. Well, this is the beginning of its life, so how much value did it lose during this period? Let's fill in our formula. That building had a historical cost of $200,000. That building had a residual value. We're estimating that it would be worth $80,000 if we made no improvements to it and just used it for 20 years. We're going to multiply that by 1 over its useful life. Speaking of, that's the 20 years that we had. So we need to take away 1/20th of that depreciable amount every single year for 20 years, but we're making a monthly adjustment. So it's 1 more time, multiply that by 1 over 12. And when I do that, I come up with 500. So our building is losing $500 worth of value during the month, and it's going to contribute $500 towards our depreciation expense. What about the other depreciable asset we have? And that is our equipment. Well, that would have its own accumulated depreciation account. So we would have another contra asset account increasing over here, accumulated depreciation of equipment. We can fill in the same inputs for the formula. In parentheses, we would take the historical cost, what we paid for originally for the equipment, $40,000. We would subtract out its residual value, what we think it's going to be worth on the last day of its useful life, which is $4,000. And here we're saying that this thing is going to lose $36,000 worth of value over the time period that we're using for. This is the time period. It is 8 years, so let's multiply that by 1 over its useful life. We'd need to take away 1/8 of that depreciable base every single year, but we're making an adjustment just for the month of June, so one more time, just like above, I'm going to multiply that by 1/12. That comes up to $375. So between these 2 different types of depreciable assets, we are experiencing a total, if you add those 2 numbers together, of $875 worth of depreciation. And we adjusted June asset depreciation. And this is happening on June 30th. We are recording that adjusting entry. And then the last adjustment we have is for the expiration of a prepaid expense or prepaid asset that we had on our books. At the beginning of the month, Company A is going to prepay $20,400 for a 1-year insurance policy on its employees, and that coverage runs through June 1st, the beginning of the period we paid for, until June 1st of next year. So we have a 1-year policy, 12-month policy, if you will. We got it at the beginning of June. June has ended. We get to record the expense for the actual cost of just this month's insurance. We can't expense the whole entire year's worth of insurance costs because a year is not passed. We can only record an insurance expense for the portion of this prepayment that expired. And what I'm going to have for my formula here is I'm going to take the original prepayment amount, how much we paid up front for this case insurance policy, and I'm going to multiply that by the number of months expired over the number of months prepaid for. So for us right here, let's find those inputs. This is a $20,400 cost that we prepaid for that. The length of the policy, the number of months prepaid for, was 1 year. So I have that for my formula. The last thing I need now is how many months are expiring. Well, we're just saying expired during June. So 1 month has expired. So what I can do now is take my original prepayment amount of $20,400 and multiply that by the number of months expired, just June 1, over the number of months we prepaid for, 1-year policy, that's 12 months. 1/12 of that insurance actually got used during the period, so we're going to record an insurance expense of $1,700. What is my credit going to be to? Well, we paid in advance for this policy, which means at this point in time we would have a prepaid account on our books that is expiring, and the amount of insurance remaining that we have prepaid for needs to be decreased because we utilized some of it. So the credit is going to be to prepaid insurance. And while the name of the account might change, it might be, prepaid insurance, prepaid rents, prepaid advertising, the setup is always the same. It's going to be a debit to the expense and a credit to the prepaid account for the amount of expiration that you have, and you find that amount using this formula. So here we adjusted for the expiration of prepaid insurance. And those are the 7 adjustments that most companies make at the end of the period. There are definitely more adjustments that companies will have to make, but these are 7 that are so incredibly common that we're going to start you out in financial accounting. Get real good at knowing these 7.